Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. I have to apologize. I have a slight cold, so I don't sound like myself. That's probably why. Well, one of the reasons anyway. Anyway, today's show, I thought I would talk about a couple different topics, and I just want to start off by answering one of the questions I get asked all the time is, what makes you different? That's an interesting question. What makes us different? I think there are quite a few things. And when you're dealing with any firm, I think you should probably ask, how they're different. I think that's a great question. And for us, I think it comes down to quite a few things. One of them being, we have a very unique method of helping people figure out what kind of risk taker they are. That's a big thing. I mean, it's huge. I'm a fiduciary, which means you have to be comfortable with what I'm doing, and I have to fully disclose everything. Full disclosure is key. I think it's common sense. I always thought it was common sense, and I just didn't understand why people wouldn't do that, because it's not like they're going to be able to be fooled forever. So basically, just be upfront. Let's talk about everything. Let's talk about the things that are important to you. I don't really care what's important to me. If you ask me what my opinions are, absolutely, I will tell you. If you ask me what I think is best for you after we've had a conversation, which incidentally, you have to have a conversation. If you haven't had a conversation with the person that's actually helping you manage investments, maybe you want to do that. Just saying. It's important to get to know somebody, to get to know what kind of risk taker they might really be. And that is not an easy task. All the questionnaires that I see out there, everybody that's answering these things has no idea what they mean. I have them. I've seen, I don't know, at least a couple hundred of those over my career. It reminds me of how old I am now. But the bottom line is, you really have to have some method of figuring out what kind of risk taker you are. And basically, so here's what I do. And this makes me different, like really different. And before I even tell you how I do it, I'm going to tell you why it makes me different. The reason it makes me different is we talk about the real stock market and what the real risk has been. Most people are talking about a statistical number when they talk about stock market risk. They call it volatility. They call it fluctuation. They call it standard deviation. I'm so glad they stopped using that term, because you had to have college level math typically to understand what standard deviation was, unless you went to private school. But anyway, so they use all these terms. Nobody knows what they mean, and they get you to sign something and decide what kind of a risk taker you are without really understanding the questions. And I just really have never liked that. So my method is a lot simpler, and I think it does a much better job of actually preparing people for what they might be up against. And that makes me different. So I was just I'm always talking about this, by the way. This is one of the first things that you have to do, is sit down. What kind of risk taker are you really? Because the stock market, or the S&P 500, which most people kind of refer to as a stock market, although that's not totally accurate, but yeah, we'll leave that for another day. Stocks in the S&P 500 tend to fluctuate a lot, like a lot. Sometimes the whole S&P 500 index, and the way that it's calculated, has a big impact on this, by the way. We'll talk about that in a future show too. But sometimes the whole index, if you're invested in an S&P index fund or SPY, that's an ETF that mirrors the S&P 500. It dropped from March of 2000 to March of 2003 over 50%. It dropped over 50%. Now, the standard deviation of the S&P 500, which has also been called risk by some unnamed institutions who I think knew better and did this anyway. I'm going to give them the benefit of the doubt. I'm just going to assume they didn't know any better. They will tell you that the standard deviation of the stock market is 16%. And you know what? That's actually correct. It's 16%. But what people interpret that as is, oh, well, I can only be down 16%. And that's not true. And the standard deviation of 16% is true. What that means is, in 2 out of 3 years, on average, roughly about 2/3 of the time, the stock market will be either up or down about 16% from its long-term average. Up or down from its long-term average. That's what that means. What people are interpreting that is that I can only be down 16%. And you know why they're interpreting it that way? Because it's typically how it's being presented. And I'm not a big fan. Because if you're only expecting a 15 or 16% decline, and you retired in March of 2000, and you put all your money in the S&P 500 because you saw what a great return it was, or any mutual fund, doesn't matter, any stock fund, the vast majority of them today, they move together, much more so than they did in the past.
And I don't know if you recognize this or not, but that was actually the beginning of last week's program. And I'm going to continue that on this week. Just got into the station here. I got held up this morning on my way in. Apologize for you having to listen to that twice. I hate listening to my own voice once, so I can only imagine. But anyway, yeah, the risk control. That's kind of the focus on my practice now, and will be, and actually probably should have been all along. And in fact, it's always been a major part of what I do. But we have a seminar coming up, and the next seminar is we're going to talk about this in much more detail. And I'm going to give you some examples on that seminar. I'm trying to find my own website. This is hilarious. Go to bullingtoncapital.com. You can see right there. Click on see my website's not responding quickly enough for my speech. 60-second retirement plan and risk control in your finances. That's the name of the next seminar. And again, we're going to constantly come back to this. Controlling the amount of risk you're taking. It's not as difficult as you may think it is. It may not work exactly the way you want it to. And in fact, I can tell you that in most cases it doesn't. That's the bad news. The good news is it's still workable. You can still reach your goals. Just because you can't get it the way that you'd like to doesn't mean that you can't be successful. Okay, so anyway, 60-second retirement plan and risk control, those things kind of go hand in hand. And you know what? I'm reading stuff on the way in. Not on the way in. That would not be good. Driving down the highway, reading a magazine. Unless you had one of those driverless cars. That would be good. That would be fun. But I was reading something yesterday, and I thought it was a very good article. And in fact, it was actually a local bank that somebody there had written. And like, woohoo, that's unusual. You see something of super high quality from a local person here. Anyway, they were talking about the sandwich generation and how they're, people in my age category are supporting grown children that are in their, mid to late 20s, and also trying to take care of their parents at the same time. I see it all the time. And there's risk there too. The risk is that you will not save enough money to support yourself because you're supporting everybody else. That's a big deal. So at the seminar, I'm going to help you figure out how much you need to be able to spend to save to support yourself. And we call it the 60-second retirement plan. And it is relatively simple. I'm telling you. In fact, I've got a bunch of calculators that have my logo on them. I'm going to give them to you. Anybody that comes to the seminar gets this calculator, and I'm going to show you how to figure out how much you need in your savings. And we call it the 60-second retirement plan. And it's not much more complicated than that. Actually, no more complicated than what we're talking about. So once you know that, then you get to decide on how much risk you want to take. And in fact, I'm going to back up a second. I'm going to correct myself. The first thing that we do with almost everybody is try to figure out how much risk you can accept. And everybody's different in this. And this is one of the most important things you'll ever hear anywhere on anybody's show. The stock market is highly unlikely to go down and stay down. Highly unlikely that ever happens. Why? Well, I could do an entire year's worth of shows on that one topic by itself. Okay. But for now, what I'm going to tell you is that we have a central bank. You may have heard of it. It's called the Federal Reserve Bank. Most people refer to it as the Fed. So we have this bank called the Fed. It's very powerful. Can create money out of thin air. It's magic. Well, it's the next best thing to magic. And what is going to happen in the future is they'll print more money to get out of financial situations we find ourselves in, like the difficult financial situations we find ourselves in, like 2008, 2009. You know, that actually started for mid and small cap stocks in March and April of 2007. Think about that for a second. So April, March, the small caps, mid caps, international emerging markets areas had already started going down, and the S&P 500 finally rolled over in November of 2007, and it took all the way until March of 2009. That was almost 3 years for the small and mid caps. It was a little bit more than 3 years for the international emerging markets, and they were down a little bit more than the S&P was. So if you look at the average stock, you know, they started correcting the first quarter at the end of the first quarter in 2007 and didn't stop the correction until the first quarter of 2009. So you go 2007, 2008, 2009. That is a long time. And they went down it went down really far. Nobody ever told anybody that was about to happen. Nobody told anybody when it was over in March of 2009 and the market had started going up so fast that all those people that had gone to cash missed a huge amount of the returns on the upside. You can't afford to miss those. Unfortunately, that means you have to stay invested. So instead of trying to guess which direction the market's going to go, and by the way, one of the reasons I'm talking about this right now, I've had an unbelievable number of calls lately. People trying to figure out where the stock market's going to go over the next 12 to 18 months. Are you kidding? The reason I'm taking that tone of voice is because these people are clients, have been clients for a long time. I'm like, are you kidding? This is 30 years. We've been talking about this for 30 years. I know, but it's different now. No, it's not. It's not different. The risks that you're facing today, we've always been facing. You got a president in there who's not afraid to slap tariffs on foreign countries. You know what? I applaud it. Is it going to cost us money? Yes, it will. But you know what else it's going to do? It's going to protect American jobs. It's going to create American jobs. Do people get hurt in the process? Somebody always gets hurt. You can't have an action, and Isaac Newton was so much smarter than everybody thought he was. Most people think he's pretty smart, by the way. But they had no idea how smart that guy was. Because he said every action has an opposite and equal reaction. You know what? That holds true in so many aspects of your life. Financial markets in particular. You make a move somewhere, it affects people and industries around the world. In some other places. Sometimes places that you didn't expect. When they start throwing tariffs on, yeah, that's going to hurt somebody, especially when you get in a trade war. It's not good, but you know what? You know it's really not good? To have foreign countries who subsidize businesses, basically say, go ahead, cut your price, run the American competitors out of business. We'll pay you back. Okay, that's what they've been doing. And you can do that any number of ways. You can manipulate your exchange rate, which China does. But they control their exchange rate. That's not allowed in this country. We're trying to play fair, and they're not. So I'm not, everybody shipped all their manufacturing over to China because they were taking advantage of the Chinese government's games they were playing against their own country. I don't feel bad for that. I really don't. I think it's unfortunate for everybody. It should have never gotten. And by the way, before that, we did the same thing with a bunch of countries around the world. A bunch of countries around the world. Basically let them take advantage of us. It's really wild. And I'm not sure it's even completely, that we didn't gain from some of that. That's why I know some industries gained a lot from it. So, but it created different types of jobs. So it's not like it was a total devastation of jobs, but it did really hurt. And it did some damage. So is it fair to allow a foreign country, to allow a foreign government to subsidize their businesses, to have them put artificially low prices in our markets and force our workers out of a job? Is that fair? So I don't know. And by the way, I'm not smart enough to know what the exact answer is. Yeah, because I'm not sure anybody else is either. Yeah, it is tough. So you have to adjust. But here's what I can tell you what the normal outcome of all this is. It's going to be inflation. It's not going to be that stocks go down and stay down. And we talked about this a few months ago. Procter & Gamble raised prices 3%. They said, oh, well, we're just going to have to do it. We're going to have to raise prices 3%. You think 3%, I don't know, what's a $20 container of Febreze Tide Pods cost? I think it's $20. So 3% is 60 cents. Are you going to notice that? Now, I'll tell you where you will notice it is when your $30,000 car goes up by $1,000. That you'll notice that. Hey, this was, and that happens. So the net effect of that is inflation. When prices start to rise, especially on the big goods, home prices going up. Wow, I can't believe I just blew through that whole first 15 minutes. Anyway, you're listening to Bill Bullington. I'll be back to explain the rest of this stuff right after these messages. Stay tuned. We're back. Hey, if you'd like to call, ask a question today, the number is 216-901-0945. And we're just kind of talking about, actually I got off track a little bit. I started talking about the trade policies. And, a lot of people confuse that for political items. And I guess down deep they are political because everything comes back to money. In fact, the CIA keeps track of all the economic statistics of every country in the world. Think about that for a second. The CIA keeps track of economic. That really floored me when I first found that out. By the way, I was thinking, what the CIA? What? And then I thought about it, and I was like, oh yeah, where there's money, there's power, and you want to be kind of aware of that kind of stuff, just to get caught off guard, right? So anyway, it's not very political. In fact, I make both political parties angry with what I say. I'm one of those people that are in the middle, and I look at the issue. Each issue by issue, try to make my own decisions, try to be independent. So, I make Democrats mad, and then I make the Republicans mad. and that's just day and age. But I do have most of the stuff I'm saying, you can actually Google it. The vast majority of things, and when I'm saying something that's just an opinion, I'll tell you, this is an opinion. So, but the vast majority of the stuff I'm talking about, you can find it online. I just happen to do an awful lot of reading, and people are really afraid right now. There's a lot of risk. They feel like there's a lot of risk. Well, you know what? There's actually always a lot of risk. That's just part of being alive, being a human. And I know what you feel like. There's a mass psychosis that comes over a population, and when it really takes hold, the stock market will go down quite a bit. And that's a psychological issue. That's not a financial one. If you look at the financials today, I mean, the economy looks stellar. It really looks strong. And what's really tough is when you happen to be in one of those situations or one of those areas where you're not seeing quite the effects of the strong economy. When you live in a place like Northeast Ohio, which hasn't grown nearly as much as a lot of other places have, you know, what's going on, what's always gone on down in Silicon Valley and all throughout a lot of California and other places, Florida, New York City, a lot of places where a lot of technology gets absorbed really quickly. They've actually had better growth than we have. So they would be more optimistic in most cases. But bottom line, it's very, very difficult to keep your mind straight, keep your mind right when you see a lot of economic malaise or you start anticipating that's going to be really bad. I got 2 calls, Annie. If you'd like to call, the number is 216-901-0945 and try to answer those calls without making anybody too upset or angry. And by the way, this is America. You're free to have an opinion, and I'll respect your opinion. You know, as long as it's based on research and fact. And by the way, if you can convince me, I'll change mine. That's how I roll. You got enough information, I'll take a look at it, and I'm not going to always be right. So, do I just press down on any one of the buttons? Okay. I'm going to go right now, and I can't really see. Good morning. You're on the Bullington Capital Show. Hi, how are you?
Hello. Yeah, is this Bill?
This is he.
This is Bill Bullington show?
Yeah.
Yeah, good. Okay. So what do you think the effect on the stock market will be when we have socialism? The Democrats are pushing socialism.
I think that's a long shot that ever gets through, first of all. But secondly, if we were to get true socialism, kind of like like Russia has it, I don't think it would be that good for our stocks. But you're talking about something that would probably take 40 or 50 years to happen, so you and I will be long gone before it gets to that.
Well, I hope you're right, but it's very, very dangerous. I used to travel in Eastern Europe and as a banker, and even a whiff of socialism is very, very dangerous.
Yeah, you always have to be diligent, that you're not getting too far, and it's hard to know. It's very difficult to know. So, but we're not anywhere remotely close to that now. It's not even coming up on a ballot. So I wouldn't worry about it until you actually have to do something about it. And it looks like that's not going to be for quite a while.
Yeah, well, I hope you're right. But
me too.
High taxes, regulation of business, everything like that could kill the stock market, because the stock market needs. Well, if you
run across 77, you're more than likely to get hit by a truck too. What I'm saying is those things that you're talking about, they have rolled back taxes. They have reduced and I agree. They've reduced the amount of regulation, especially the over-regulation. And the pendulum swings both ways. You'll get some people coming in when they get tired of certain things happening, and it'll change. And then they'll get tired of that, and it swings back the other way, and it changes back the other way. But you do have to be diligent, I think. And that's one of the things I like about this country. We still have a Congress and a Senate who have to agree with everything. There has to be a majority agreement. One person can't control everything, and I really like that about the United States. So I'm really glad to be here.
Yes, well, that's true. But I see dangerous trends, but the stock market needs economic growth.
The stock market has had really good economic growth. In fact, the regulations that they've taken out of the market over the past few years, I'm sure have had a very positive impact on the stock market. And they're not talking about putting anything in place right now at all. So I understand what you're saying. I think you're probably looking too far into the future, because none of that is being proposed right now. And we don't have anybody standing up to try that's got enough power to do anything like that. Eventually, yeah, it may be a real risk. but right now, not so much.
Well, the Green New Deal is socialism.
They didn't get that put in place.
But all the candidates that are currently running are supporting it.
Yeah. Well, hey, Richard, I got another guy that's been on hold since I first called you, but you're welcome to call me in the office if you want to talk more about this. But right now, I would just say you're actually borrowing trouble. I don't know if you remember what that term means. Nobody's used that for about 20 years. But it's not happening yet, but you do need to keep your eye on it, for sure.
Yeah, definitely.
Yeah.
For sure. Okay, thank you.
You have a good weekend.
Yeah, you too.
Thanks.
Bye-bye.
Jerry, how you doing?
Hi. How are you today,
Good.
Professor Bullington?
I don't know about that.
Okay. Well, if Richard would like to entertain wagers on the U.S. going socialist, I'll give him 5-1 odds.
Okay.
Give him my phone number if you would, please.
Right. Sure. That's awesome.
Well, speaking about growth, I have one stock specifically I'd like to talk to you about, Beyond Meat. I haven't heard that mentioned. I haven't been on the air for too long either, but what do you think of that?
Well, that's very interesting because I had a client call in and want to invest in it. Thing is, she wants to be a buyer and holder. And I'm not a big fan of having done that. So I'm going to show you the first price that it opened at. It was 46.
Mm-hmm.
The high on that first day was 72.
Sure, nice movement on it.
Yeah, a couple days later, goes all the way up to 70 or 85 rather, and then 2 days later, it was down to 61. And so here's the thing about the numbers. I'm a big fan of using the numbers, and when you look at the numbers, these guys have a market cap of $6 billion so far. That's a lot of hamburgers, by the way. Especially, I don't care if they're beef or soy or whatever they are. That's a lot of stuff. If you look at the total revenue they had in 2018, it was $97 million.
Right.
That was up a lot, and that thing is growing super, super, super fast.
Mm-hmm.
But and let's just say the sales, maybe they double over the next year. So give them the benefit of the doubt. They go up 100%. Let's say it's $200 million. Okay.
Pretty aggressive, yeah.
Yeah. So you go from 97 million to 200 million in a year. All right. So 200 million times what equals 6 billion?
Billion, exactly. Yeah.
It's 30. And Jerry, if somebody offers you 30 years worth of your salary so they can have your job and you don't take it, you are never allowed to call into the show again.
Well, that's precisely where I'm coming. It is just on fire. I was looking at options on it, selling put options.
I wouldn't do that. Yeah, I wouldn't sell a put on it.
A couple of weeks ago, and for I think it was the $90 put options, you get a
dude. You are
premium.
playing with fire. You are literally playing with fire. That is not something I can condone, especially for the average listener.
Certainly not.
No,
not for the
I
average.
would sell a call before I'd sell a put, and I wouldn't do that either because it's just too unpredictable. People love this company. I mean, they love this company like people loved Amazon in 1999, right before it lost 95% of its value and took nearly 10 years to recover. People forget that. And so people love this company because it's, the cows are not filling the air with methane gas for all this stuff. It's just crazy. It's crazy. And at some point in time, maybe if it comes down, if the valuation drops, if the sales grow. But right now, the math makes no sense whatsoever. And it reminds me of in the year 1999, if you took the Russell 2000 and you subtracted from those 2,000 companies, okay, the 2,000 companies make up that index. That's how it got its name. If you take all the companies out of the Russell 2000 in 1999 that were profitable that year, that had a profit, had a good year. Normally, a profit's considered pretty good unless it's actually a lot lower. But anyway, if you subtracted out all the ones that had profits, and just kept the losers, the money losers, your value actually went up. You made more money investing in companies that were losing money than you did if you had invested in profitable companies.
Wow.
Now, that is the epitome of a bubble.
Yeah.
And this Beyond Meat, it's a bubble.
Well, Beyond Meat, they're going, now that they're public, they're going to have to come out with a financial statement on a quarterly basis. Do you have any idea when that might be?
Hang on, I can probably look really quickly. I just pulled up their financial statements. Their financial statements are on Y charts, by the way.
I didn't know that. I thought that, well, they haven't had a full quarter public yet, so I don't think it's available.
Yeah. No, they just looked at what they filed in their offering memorandum, or the prospectus. I can't even remember what they call those things anymore. That's hilarious. But the let's see, they have no.
They used to call us the red herrings, correct?
Yeah, that was when it was filing to come out. That was like a pre-form to give you an idea of what it was.
Yeah.
So in 2016, they reported $19 million in revenue. In 2017, they reported $37 million. And 2018, it was $97. So that's why I'm saying if you even if you got 100% growth, let's say you tripled the growth, it goes to 270. You're still paying over 20 times sales.
Sales, not earnings,
right?
Sales.
Yeah.
Yeah.
So that is a wow. And everybody that talks to me about this is not a trader. These are I've had multiple people calling about this. And I'm like, you don't understand. This thing it's just like the internet stocks were in 1999. It's just like them. And it's more than likely going to have a repeat performance. And my whole, like the seminar I got coming up, it's on controlling risk. And this is what I'm talking about. Back in the late 90s, nobody listened. They were, you don't know anything. These stocks just keep going up. And I'm going, yeah, they will until they don't.
Go down, yeah. Well, I was just going to ask you, I did try their product. Have you tried it?
No.
It's actually a fairly good substitute, and I consider myself, I have a fairly critical palate, so to speak. They do make a decent burger. It's hard to tell the difference. It's quite similar to like a turkey burger or something. It's a little lighter, but...
Yeah, and you know what? Amazon actually sold a lot of stuff, and it was very, very convenient, and it was a great experience back in 1999.
Uh-huh.
Right when it peaked at $113. And then in the year 2001, when it was selling for $5.50, it was still doing a good job.
Amazon went from 113?
Yes.
Whoa.
And I just said that earlier. You weren't listening.
No, I didn't hear. So I said I just got
I know.
Here.
I said it. You didn't hear it. I keep saying it. And I'm telling you, I'm going to keep saying this. And by the way, it was just a little overpriced. That 60-second test that I've been talking about, I guess I'm going to have to do that at each and every seminar I do because it only takes me 60 seconds. The directions to follow it until you've done it for a while, it's going to take you longer than 60 seconds. I'm going to tell you that right up front. So that's a spoiler alert. It takes me 60 seconds, and if you practice it for a couple of hours, it would only take you 60 seconds, and then you would be able to identify how much risk is in a stock. If you wanted to carry that over into your investments, you can look at the top 10 holdings in the funds that you own, do that 60-second test. You'd have a really good idea of how much risk you're taking in that fund. Because in the late 90s, the funds that had the best track records were also taking the most risk. Those were the ones that end up losing the most when the market finally turned. But
wait, just to go a little further, if you would
I got to take a real quick commercial break. Do you want to hang on there?
Sure.
Okay, you're listening to Bill Bullington right here on 1420. I'll be right back.
I was burning out.
And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Also available on the 955thefishpodcast.com. I'm sorry, 955thefish.com as a podcast. Boy, he gets talking so fast sometimes. Anyway, I got to go back to Jerry. Finished phone call. Hey, Jerry, actually, I picked up Walter. Sorry, Jerry, I'll get to it in a second. Walter, are you there?
Yeah. Bill, talk a little bit about the trade wars.
Mm-hmm.
Since the tariffs have been put in place by the Trump administration,
Right.
trade deficit last year went up 12%.
Yeah.
Over
that.
the year before. So, I mean, is it working? I mean, the whole point he was very critical of Obama and Bush. Look how the big gap, and it's got worse under him. So that's proof that the tariffs are
no. That's not proof. There's no way you could make that statement. I was an econ major, and I know better than that. So you need more data than that. The tariffs are really highly debatable, and there's so many more things that come into the decision-making process than just the prices. That it's really, you have to take a look at the big whole picture. And everybody wants to do this. I do too. It's called heuristics. It's called wanting to simplify things to something that's like just one or two items. And in many cases, you just can't do that.
Well, one of the things about the trade wars is the dollar is strong. And a strong dollar makes American goods and services very expensive to foreign countries.
Yeah.
So they buy from other countries.
You have to look at why the dollar is strong, what is causing that. And I'm telling you, there's just... there was a reason that you go to most colleges and you get a professor that's more than 28 or 29 years old. He'll remember how the science of economics was called the dismal science. It's because there's an awful lot of things that can come into play at any moment in time. And yeah, there are certain things you definitely don't want to do or you don't want to overdo. And when I look at the total amount of taxes, quite personally, I probably would have been a little more heavy-handed. But to think that that's actually going to cause a dramatic impact, it was such a relatively small dollar amount to begin with. It was mostly rhetoric and its positioning as far as I'm concerned. But anyway, none of this, by the way, helps you make money. It won't help you avoid a big correction. It won't tell you when the next rally is going to come. And
it's creating the volatility of what we're going through right now.
Well, but there's always something creating volatility.
True.
That's just the nature of the beast.
Okay. One question about socialism. I heard one of your guest callers say to talk about socialism.
Right.
You look at Mexico and you look at Canada. Canada's always been considered more socialistic than Mexico.
Uh-huh.
Who do we have more problems with?
Yeah, I don't really know. I haven't kept track.
But in other words, you have a lot more problems with Mexico, which is considered an oligarchy, than Canada, which is a more of a socialist country, but a hybrid like we are. The truth is, when people say socialism, there's different kinds of capitalism and socialism. And
you have to have them define exactly what they're talking about. And by the way, the vast majority of people, when you say, could you define that for me, they get mad at you.
Right. But here's the thing. Most countries these days, and China's an example. China's a communist country, but they have a capitalist bent. Most countries are hybrids.
Yes.
It's not one thing anymore.
Yeah, you got it. Absolutely. So, yep, a lot of complicated stuff out there to deal with. The bottom line to the whole thing, which I think is kind of funny, is at the end of the day, everybody gets together and says, you know what? We're just going to have to print more money.
Yeah, right.
And that's been the answer now for about 30 years. Yeah, more than 30 years. And that's what happens. That's why I keep telling people, inflation's the real risk in retirement. That's the real risk, is inflation, because it's going to happen. And you got to be prepared for that. You got to try to do the best you can. You got to work within your own personal risk tolerances. You got to find out what kind of risk you're actually taking. You have to find out what kind of risk you might need to take to be able to reach your financial goals. And hopefully those are one and the same, but most often they're not. It's a tough thing to do. And that's why I decided to have that seminar on it. And you don't have to go to a seminar, by the way, to talk about that. You can set up a meeting, and I'll show you how we do it. If you're interested in it, then I'll show you what we do for our clients. So just want to make that clear to everybody that's listening.
Speak about Gerry. We mentioned about the Beyond Meat, I think it was, the company.
Yeah.
Burger King has a Impossible Burger right now.
Yeah. Oh, believe
plant-based,
me. That's the other thing. Everybody on the planet, I mean, there's nothing proprietary there. Anybody can make that stuff. You know what I'm saying?
Right. So, you know what's coming in the future, Bill? I saw this in one of these futuristic programs. they are have a system. It's still decades away where they can sell off a cattle like a cow,
right,
and create meat from not slaughtering the cow.
Right. Yeah, I've seen that before too. Pretty interesting. Hey, you know what? Well, I'm actually going to have to run, but I want you to thank you for calling in today. Made the show much better.
Thank you for listening.
I appreciate it. Have a good weekend.
You too.
Bye. You. You can call in 216-901-0945. Sorry to stir the pot. I really didn't mean to do that. Economics is actually only taught in America as economics, as standalone. In most other countries, it's taught as political economics, which is kind of what it is. Everybody's got their different ideas. The nice thing is, in this country, you are entitled to your own opinion. That's great. And one of the biggest things I think you could do, it doesn't matter what your opinions are, but when you're sitting down to figure out how much money you need to last you through retirement, one of the bigger concepts that you're going to have to struggle with is the amount of risk you're taking, because the risk-free stuff doesn't pay a whole lot. We'll talk a little bit more about that after I come back from Jerry again. Jerry, thanks for waiting patiently.
Hey, hi, Bill. It's Jerry back.
Right.
Okay. Two things. What would it require for you to become interested in Beyond Meat?
It would have to drop in price by about 85-90%.
Okay, that's first thing. I purchased some 3M on the down. At this point, it's gotten roughed up pretty good. Would you be a holder or a seller of it, or maybe a buyer?
If 3M is I'm absolutely sure it's in one of the ETFs that I own. Uh-huh. I know it's in there. So it's not something, when I look at it, if I'm going to buy a stock personally, just individually, it's got to have either a really, really, really strong valuation where it's undervalued by, at least 50%. That way I'm shooting for a minimum of 100% gain. Or it's got to have like a Procter & Gamble. I sold my Procter & Gamble, by the way, not too long ago. It's still in some of the ETFs I own, but I sold the individual position because it wasn't undervalued anymore. When I bought it, it was a lot cheaper. So today it's still okay, but at 4 times trailing revenues, that's right about where that stock should be. And when I bought it, it was right around 3. So I got a nice dividend for the time that I owned it, and it's no longer underpriced. Now, if it comes back down, I'll pick it back up again. Sure,
and it's a safe stock, so as any stock can be.
Right, safer than a lot of them. Yeah.
Right. I think you would agree with me that the reason we've had a slide in the stock market is because of the tariffs that are being imposed or threatened.
Well, see, that's the thing, Jerry. I don't agree with that.
You don't? Okay.
No.
The trade war with China, you don't think it's a collective?
So here's an exercise I want you to do.
Okay.
I want you to write down in a notebook, I want you to date every feeling that you have, every thought that you have about where you think the market's going and why. Now, I did this for about 18 months once, every day. You don't have to do it for 18 months. I figured out after the first 6 months that I was horribly wrong by looking at the headlines, figuring out what those headlines meant in the stock market and how that was going to affect it. Okay? And if you do that exercise, no, I have to insist on this. You're not allowed to talk about it until you've done that. Because what you're going to find is that the market shifts on a dime, and it's never, the headlines are rarely there to tell you what's going to happen. They're really good at telling you what just happened, like as if anybody with eyes couldn't have seen that. This is what happened. And by the way, they often make up things about who's selling. Do you know how many funds there are out there?
Oh, good Lord. I could only guess.
So if you were to take a poll of the several thousand fund managers out there, first of all, how long would it take you to take that poll? Secondly, by the time you got the poll their opinions, half of them will have changed.
Of course.
Okay, so what you can do is you can just observe what's happening. You can't make a lot of inference over what's going to happen over the next 12, 18, even 24 months. If you're not investing over the next 5 years, you're making a mistake. That's a mistake. Hey, I actually got to take another commercial break. Did you want to hang on?
Okay. I'll let you get going. Thanks so much for your time, Bill.
Thank you. Listen to Bill Bullington right here on 1420 The Answer. I'll be back right after these messages.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.